Welcome to Nerdbull1669 Weekly Trading Outlook tips for this week, 9 to 13 of February 2026. Before we move to this week, right, the first week of February 2026 trading was a roller coaster of Groundhog days. Optimism followed by a midweek slump after a strong start on February 2nd, fueled by a trade news. Market shifted to a risk-off stand as labor data and the tech sector rotation take center stage. So coming next to the market summary of last week. Okay, second for last week, 2nd to 6th of February 2026. The week was characterized by the high volatility and a sharp rotation out of the software and the AI gold name. So for the S&P 500, it ended the week roughly negative 0.1% to negative 0.5% lower, closing around 6,930. It suffered a 2% midweek drawdown before a massive Friday recovery. The best single day gain since the May saved the index actually from a deeper losses. So for NASDAQ Composite, the tech heavy index right was a lagger, down nearly 3.9% for the week, closing near 23,026. Concerns over AI capital expenditure payback and a massive 24% year-to-date plunge in the software ETFs IGV weigh heavily. So for the key driver that is actually causing this, so we are looking at economic data. So a partial government shutdown actually delayed the official job report to next week. So however, private data show that there's actually rising unemployment claims, fusing recession fear in the midweek. So for on the yield side, right, we're looking at 10-year treasury yield actually fell to 4.2% as investor sought safety in bonds instead. So on the corporate side, so Alphabet and Amazon massive 2026 capex right guide, which is looking at more than 175 billion, initially spooked investors concerned about the ROI on the AI artificial intelligence. So next, now we come to next week. We come to this week market outlook 9 to 13 February 2026. So this week is a critical junction with the delay January job report that is coming on the 11th of February, and the CPI inflation data that is coming on the 13th of February are back both on that. So on the S&P 500 weekly outlook, right, we are looking at S&P 500 need to maintain the primary uptrend for a trend continuation, and it need to reclaim and hold 6,950, a close above the January all-time high, which is near the 6,980, would signal a resumption of the bull market. But coming on the pullback risk, right? So if Friday rally right fails to find a follow through, so a retest of the 6,750 to 6,800 zone, right, is likely. A break below the 6,750 would suggest a deeper correction towards a 200-day moving average. So on the NASDAQ, so coming to the strength and the failure for NASDAQ. So we are looking at the strength above 23,650, reclaiming this level, right, which actually is the broken November 2025 uptrend support. It's necessary to negate the technical damage from the software sell-off. So the failure, right, we are looking at below 22,500. This level was tested this week. A sustained break below this trapdoor would open a path going down, to a even lower, all the way down to the 21,800. So appreciate if you could share your thoughts in the comment section on this video, and do help to like and share this video. We greatly appreciate your help. Yeah, for the disclaimer, so do note that the analysis and the result presented does not recommend or suggest any investing in the said stock, or and then this is purely for the analysis and technical education purposes. Appreciate if you can like and share this video if you find this video useful and helpful for you. Thank you for your support, and we look forward to you supporting the channel for more content. Heading into the critical week of 9 February to 13 February 2026, the macro landscape is shifting from a state of complacent calm to one of the active revaluation. Investors are grappling with a leadership transition at the Federal Reserve, and a sudden realization that the AI ROI or return on investment timeline may be longer than expected. So on the macro snapshot, leading into the 9 and 13 February week of 2026. So on the risk appetite, we are looking at a fragile rebound. So the risk appetite is currently characterized as fragile and polarized. So rotation is key. So there is a pronounced move away from high multiple software and pure play AI names into a real economy sector like a value, energy, and infrastructure. So on the sentiment shift, so while the S&P 500 saw a massive Friday save on the February 6th, the underlying sentiment remained jittery and due to a 2 trillion wipeout in the crypto market cap since late 2025 and concern over the AI capex bubble. So the current state, neutral to cautious. Investors are buying the dip, but with much tighter stop losses than in January. So coming next to the rate direction. So we're looking at hawkish hole. So the interest rate outlook, has come under the intense scrutiny following the January FOMC meeting and the nomination of Calvin Walsh to succeed Jerome Powell. So the Walsh effect, so market are actually fearing the hawk. So Walsh is actually perceived as wanting to shrink the Fed balance sheet more aggressively, which has pushed Treasury yield towards the 4.25 to 4.3% range. So we look at pause in play. So after cutting rates to a range of 3.5% to 3.75% at the end of 2025, the Fed is now in a wait and see mode. So what will be the upcoming catalyst? So it might be the delay job report that is actually scheduled to release last Friday, but actually was scheduled to release now on the 11th of February, Wednesday. And also we're having CPI this week on the Friday, 13th of February. This will determine if the Fed actually remain on hold for March or if a re-inflation scare forces them to signal a longer pause. So on the volatility regime, so shift to elevated. So we have transited out of the low volume regime, which VIX stands at 13 to 15, seen throughout March of late 2025. So VIX level, the fear gauge surged to a 2 months high of 22.53 in early February. The ODTE factor, the 0-day, the short dated option now account for nearly 60% of the S&P 500 volume, creating a gamma heavy environment where intraday swings are more volatile. So the regime type, we are looking at high beta volatility, expect a mean reversion attempts, but the floor for the VIX has likely shifted higher. 18 is the new calm. So as geopolitical tension in the Middle East and the Eastern Europe remain a structural risk. Now coming to the weekly outlook for the S&P 500 for this week, 9th of February to 13th February 2026. So S&P 500 will need to maintain the primary uptrend in order for a trend continuation. The S&P 500 must reclaim and hold 6,950, a close above the January all-time high, which is near the 6,980. This would signal a resumption of the bull market. But the pullback risk, an investor will need to, take care as well. If the February rally failed to find a follow through, a retest of the 6,750 to 6,800 zone, right, is likely. So a break below the 6,750 would trigger a deeper correction towards the 200-day moving average, as shown in the chart above. Now coming to the really outlook for NASDAQ. So NASDAQ need to reclaim the broken November uptrend support at 23,650 in order to negate the technical damage from the software sell-off. So for the strength above 23,650, this will be the level that need to reclaim to negate the technical damage. And then if anything were to fail below the 22,500, right, this level has already actually been tested last week. So a sustained break below this trapdoor, right, would actually open, a path, right, for a downtrend all the way down to the 21,800 level. Now coming to the weekly level for Cisco, CSCO, which will be reporting its earning on the 11th of February, Wednesday. So it's actually trading near the 26-year high, and then the bias is actually bullish above the recent all-time high. So invalidation would actually occur if it actually break its 50 days MA at 76.97 post earning. So actually we are looking at the bullish bias, right, above 83 dollars and 25, and then invalidation will probably occur below the below the $76.50. So coming next to the weekly level for Coca-Cola, the ticker KO. So Coca-Cola actually remain a safe haven play. It's actually above the psychological resistance, and then it will be also reporting its physical Q4 2025 earnings on the 10th of February on Tuesdays, and then it actually remain the safe haven play. And then we have been seeing the bullish, and then we would be looking at the bullish bias happening above the $72 level, and invalidation level might be occurring below the $68.50 level. So coming to the weekly level for Broadcom, AVGO. So for Broadcom, right, it will be actually a massive volatility on the capex, AI capex news. So it would be bullish, right, if it can clear last week high, invalidation below the February 4th low, where valuation concern peak. So for the bullish bias, right, we're actually looking at a level above the $355, and invalidation, we think that it might occur below the $308. Coming to the weekly level for NVDA. So NVIDIA would be actually looking for a bounce, right, above so-called towards the $300 target. So $180 psychological support need to be whole. So it would be a break below it, right, will invalidate the current growth narrative. So we are actually looking at a bullish bias, right, above the $215 level, and invalidation, we think that it might occur below the $180 level. So for the key catalyst this week, right, we are actually looking at the Cisco CSEO report earning on the Wednesday 11 of February, and Coca-Cola KO is actually in the lineup, which actually reporting earlier on the 10th of February. So these reports would likely dictate the value versus tech rotation for the remaining of the month. So, and then we must also take note of a CPI inflation data that's happening on the Friday 13th of February. So a bit of the risk management framework. So these are the three things that we should always keep in mind. So trade levels are not the opinion, and we should define the invalidation before we entry, and then also reduce size during the consolidation. Do practice discipline and patience with. So this video is actually for educational content only, and it's not financial advice. So the disclaimer, so the analysis and the result right, as you presented does not recommend or suggest any investings in the state stock. So this is purely for analysis purposes.